This is Tony Moeller and Matt Aarons with Integrity Advisory. First, we want to wish you a happy St. Patrick's Day. Also, we want to just touch base on what's been happening with the markets. And along those lines, we got some charts we'd like to touch base and give you some information on. On the first chart, what we can see is if you look at the history over time from 1980 through 2019, over a 30-year period, you can see the market has big swings throughout the year, huge intra-year declines. When you look at this chart, you can see the blue upside and the orange downside. The orange represents every year how far the market went down during the year. The blue represents where it ended at year end. So when you look at it, the vast majority of the time over this 30-year period, you're in the green. It's actually positive. And if you were to look at it, you can see the overall trend is positive. But even in years where the market's up 10, 11, 12, 13, 14, 15%, you may be down 20% at any time during the year. So this is not abnormal to see. The other thing we want to talk about is the history of bull and bear markets. And what this chart shows us, going all the way back to 1926, all the way through 2018, bull and bear markets occur. They're just a part of investing. But when you look at it, the blue represents the bull markets, which are slow and plodding. The orange represents the bear markets, which are fast and furious. Bear markets on average last 1.3 years, and you're down a cumulative 38%. That's someone who's 100% in the S&P. If we look at the flip side, bull markets last an average of 6.6 years, but you're up a cumulative 339%. So the point being is 80% of the time, the market is in the positive. We often lose sight of it because, yes, bull markets are slow and plodding. We get lulled into complacency. And then when a bear market hits, it's short and violent, so it scares us. But the odds are in our favor. And if you look at the last chart, this is what history's showing us. If you look at the top area when it says to keep things in perspective, it shows us Black Monday, the Gulf War, Asian monetary crisis, the tech bubble, the financial crisis, and various other events. You can see where the U.S. stock indices were down anywhere from 19% to 57% during that period of time, traditional bear markets. But in the next 12 months, it was up anywhere from 21% to over 68%. So the point being is the market comes back from periods like this, and it presents opportunity. The last piece just shows you if you were to go back in time to January of 2000 through December 31st of 2019, a 20-year period, you had $100,000 and you had left it in the market. And this is right before the dot-com bubble. If you stayed fully invested, you can see it would have grown to $324,000. However, if you got scared and you missed 10 of the biggest gain days, and the big gain days are usually after big down days, your rate of return was cut in half. And the last piece of it shows if you missed just 25 of the biggest gain days out of that 20-year period, your rate of return was cut significantly, and actually you'd be in a loss position. So the point about all this is about staying the course and staying with what works over time. Matt, in regards to that, I know you have some comments about what we've seen recently in the market and the rapid decline.
Yeah, so up until today, St. Patty's Day, the Dow Jones, S&P 500, and the NASDAQ are down roughly around 30%. Actually, after St. Patrick's Day, they're down roughly around 27%. One of the charts that Tony had alluded to earlier that we went through showed the drawdowns from the top to the bottom in 2008. So in 2008, we actually saw almost a 50% decline from top to bottom before we settled in around 37 to 38% decline. Not necessarily saying that we think that is going to occur, but there's a lot of underlying tension in the markets at the moment. That has to do with a number of different factors. Certainly there's a lot of fear around the coronavirus, people staying home, not spending money. The government's doing what it can, but realistically, until we start to see better testing, more confirmed cases of the coronavirus, I think we all would be in agreement there's probably more cases out there than what we currently know about, then there's going to continue to be a lot of fear in the market. And if you think about trends over the last decade, there's been a lot of movement towards passive investing using ETFs such as SPY, which just replicates the S&P 500. It's now very easy for people to satisfy their emotions in a down day or a down period to just hit the sell button and they're out of the market and go to cash. So this is kind of amplifying everything. And when you think about the returns that we've seen over the last less than a month, we've experienced practically an entire 2008 in less than 1 month. Some of this has to do with the market trying to catch up with the implications of people not going out, not spending money. And some of it is also just the emotions of people who they want to go to cash and just take care of the pain that they're feeling. One of the worst case scenarios that we saw from Goldman Sachs this week still had, by the end of the year, the S&P 500 back at 3,200, which is up significantly from where we're at today. So while we think this is going to be a process over the next few months, there is certainly light at the end of the tunnel. And when we do start to have good news related to the coronavirus, which took about 2 months in China, it's taken about 2 months in South Korea, optimistic side, maybe 2 months here in the United States, we are expecting more so than before, more of a V-shaped recovery, which is why we want to be in position to take advantage of that recovery. I will say that one of the things we did do, we are seeing some real stress in the financial markets, specifically in fixed income and the high yield bond space. So we have made adjustments to portfolios today to reduce our exposure to high yield bonds. And we just went to cash in that position. So we are doing things, trying to be proactive, especially on up days, to take a little bit of risk off the table, but still want to be able to capture the upside in the event of a rebound.
And that's the one thing that I like. We're making adjustments. This is not a wholesale makeover. The other thing to take into account, and Matt, you talked about the ETFs. A lot of what we've seen with the accelerated downside has been program trading, where people are using algorithms and some of the big players on Wall Street to where they're just trying to make small fractions of a penny on millions of trades. And that when one program starts to sell, it triggers other programs to sell, and it can accelerate on the downside. But when they buy, and it can accelerate on the upside. That's not really investing, that's trading, and that is having an impact on this market in the short term. We want to keep you updated. We want to keep you informed. We're going to be sending out emails as far as how things are doing. If you have any questions, feel free to call the office. But we are going to be updating everyone through emails. So if you have questions, feel free to respond via email or give us a call. We're here to help you. Thank you.
Thanks.